Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Tuesday evening. It is May the 9th. And yes, this is my second video for the evening. Trying to catch up here, right? So Occidental reported earlier. Make a video about Occidental a little bit later. I previously made a video about Occidental saying, basically it's not you, Oxy, it's me. But we're kind of breaking up because I don't like it as much as I used to like it in the past. If it's not a growth stock, it's got to be a value stock. And it's not a value stock because it's not paying me dividends and it's focused on other stuff, like carbon capture and all that kind of stuff when it's supposed to be drilling. Anyway, we'll get to Oxy later. Oxy reported today earnings surprise, earnings per share negative 3.68, below the estimate. And they missed the I'm sorry, that's revenue. Revenue estimate came in at minus 3.68, and the earnings per share earnings came in at negative 16.15 versus the consensus estimate. Anyway, I don't really want to talk about Oxy now. I want to talk about Devon, man. This Devon is a powerhouse, and Devon Energy is looking good. I've been buying Devon as well, so it might be something that you're interested in or not. I'm not too sure, but Devon, for me, looks a lot more interesting and entertaining than Occidental Petroleum, which has kind of become Me Too or Meh or whatever you want to call it. So I'm no longer going to call myself Mr. Oxy. I won't call myself Mr. Devon either because I'm not that confident in this particular equity. But I like it, man. It looks pretty good from this point. So they just reported earnings. So this is Devon. And then their conference call was today. So this is some of the conference slides. I'm going to run through them quickly. Then we're going to take a look, quick snapshot, a look at the quick snapshot of the stock and see where Devon is. So here's some takeaways. This is from the marketing department, right? Not from me. So if it looks too glossy and glitzy and glamorous, this is not my work. This is theirs. And they pay a lot of people top dollar to create some really beautiful marketing slides. So repurchased $692 million worth of shares year to date. It's pretty good, huh? And I mean, it's like literally only April, and this is first quarter, right? So 3 months. Buyback program expanded to $3 billion. So this is kind of a little bit forward looking. Fixed and variable dividend declared, total dividend of 72 cents per share. That's pretty good, huh? It's almost $1 for every share that you hold in Devon. And oil production, new all-time high. And on track to achieve 2023 capital objectives from a CapEx point of view. Disciplined business, disciplined growth strategy, consistent revenue rates, prioritize free cash flow, low leverage. I like that one. I like companies that do not have a lot of debt. I don't like this EBITDAX formula of 0.6. We'll take a look at the debt in just a minute. I'm not a fan of EBITDA in general, earnings before interest, taxes, depreciation, and amortization. It's one of those fake GAAP accounting numbers, right? I'm old school, man. I want to count the cash that's in the cash register, not something based on conjecture and forward planning and guidance and all kinds of other funky stuff, like show me the money. Strategy, no change to disciplined cash return framework. I like that one too. Return more than 120% of merger valuation to shareholders. All capital requirements fully funded. At $40 WTI. Now we know WTI is currently sort of hovering around $70. So when they do their CapEx requirements at a price of around 40, it's pretty good. So far so good. We'll get into the dark side in a minute. Assuming there is a dark side, executing on our plan. Oil production, 320 million barrels of oil equivalent per day. It's up 11% compared to Q1 of 2022. Total capital, $988 million within guidance. Production cost, $12 per barrel of oil equivalent, which is down 2%. This is really fantastic. If you can get your production costs down by 2% in an environment that is actually sort of still relatively hyperinflationary, that's pretty good. Free cash flow, $665 million. And this is a sweet company, man. This is doing good stuff over here. Delivering an advantage cash return yield, you betcha. 12% total yield, Devon. Compare it over here to the energy sector as a whole, which is actually quite rewarding for investors. It's close to 4% just on average. I mean, even XLE, my favorite ETF, returns around 3.5%, 4% in dividend yields, and its primary holdings, XLE, is Exxon and Chevron. Can't go wrong on that one there. History of cash return, superior yield versus other market opportunities. And, to be fair, like I just made a video on ICANN, right? So if you want to jump out of ICANN and into something else, Devon might not be a bad jump into spot for you. Devon might be the bullseye that you're looking for on the dartboard. Paid quarterly dividends for 31 straight years. Pretty good, huh? Differentiated fixed and variable dividend policy. I like that one too. They make a small fixed portion and the variable is subject to free cash flow. Buyback authorization I talked about. So this is the authorization, $3 billion, expanding the share repurchase program. Repurchased 692 million of shares year to date, $1 million. The board approved a 50% increase in the buyback program. Upsize authorization 3 times since the inception. Program represents 9% of the outstanding shares, right? Man, investors have got to like this. The other thing that's interesting about this, just for the sake of example, I started this video rambling a little bit about Occidental Petroleum. So Occidental made a big noise when they implemented a share buyback program of $3 billion. But Occidental at the time was a $60 billion company, and Devon at the time was a $30 billion company. So there's quite a difference between $3 billion buyback program from Devon compared to a $3 billion buyback program from Occidental Petroleum. Investment grade financial strength, reduced outstanding debt by more than $1.2 billion since the merger closed. Net debt to EBITDA, so here it is again, right? 0.6. I'll come back to debt in a minute. Significant flexibility with minimal near-term debt maturities. 60% of outstanding debt obligations mature after 2030. Looking pretty good from a liquidity point of view. I'll come back to that one too in just a minute because I'm going to go into some of the fundamental slides just as a snapshot. I'm not doing a deep dive here, right? A couple of highlights here: improving investment grade financial position, total liquidity $3.9 billion. You're always going to look under the covers on this one because it includes cash and a credit facility. The credit facility is almost $3 billion, so the cash is actually about $9 billion. There's the cash position, $9 billion. I just said so. Oops. Low leverage, 0.6%. They keep saying that, hey, debt to EBITDA. There's nothing wrong with saying that. But you know what? Talk about debt rather than debt to EBITDA, right? So don't give us numbers that are deceptive. And I'm not complaining. I mean, everybody does it, but like EBITDA, whatever. Debt reduction, more than 1.2 billion since the merger closed on January 7th, 2021. Pretty good. Okay, so let's take a quick look here at the snapshot. You can buy Devon for $50. It's insanely cheap. That's a sweet deal. It's a pretty good price. The earnings per share, 9, right? So PE ratio of only 5.5. It's profitable, pays a dividend of nearly 10%, $5 on a $50 stock on an annual basis, yielding almost 10%. It's a $32 billion company, sitting way to the left on its 52-week range. This thing's got significant upside if you ask me, but you didn't ask me, so I didn't say that. And it's generally been outperforming over the past 3 years, the indices quite easily. Significantly held by institutions. Institutions like it. Not a lot of short interest, 2% of the outstanding float. So 2% of the 643 million shares that are outstanding in the marketplace are currently short. So there are some people who expect Devon to go down more than the 3.5% it went down today. But in my humble opinion here, this is a sweet deal at $50. Tip ranks. The analysts, what do they say? 9 guys have a buy rating, 10 guys have a hold rating, no one says sell. Got an average price of $67 per share. Now, remember, it's currently trading at $50, right? So if it goes to like $70 or thereabouts, that's kind of a sweet uptick of around 40% or so. You can see some of the analysts, if you go to tip ranks and see what their rating is, maintained 17 hours ago. Gabriella maintained her rating 17 hours ago. So interesting stuff from the analysts. But you know what? It's easy being an analyst. If you get your estimate wrong, you just make an adjustment, publish a new one. How about valuation? Price to sales is less instructive than the price to earnings because the company has positive earnings. If you look at the positive earnings, then you can see that Devon is currently slightly cheaper than the industry average, which is around 6.25, Devon at 5.59. And at the bottom, the price to book, Devon 2.98, the industry is at 6.4 for the most recent quarter. But the PE at trailing 12 months, 5.59, indicates a relatively inexpensive stock. Devon seems fairly valued with a PE of 5.59 that is in line with the oil, gas, and consumable fuels industry median of 5.3. So, one of my references to Oxy, for instance, when I started the video, I talked about Oxy, and I said it's like, meh, me too, or whatever. Many of the energy stocks are kind of cheap right now with a PE ratio below 10, which indicates that just based on a quick snapshot using the PE as a benchmark, the stock is kind of cheap. But some of them are cheap for all the wrong reasons because they're not going anywhere. So in the case of Devon, its PE ratio is not dissimilar to Occidental Petroleum, but it also pays a 10% dividend, so it's like a no-brainer. Devon has typical profitability characteristics of the company in the oil, gas, and consumables fuel industry, but it's better than most at converting revenues to profit. So how better? Gross profit margin, Devon, 55%. The industry is around 42%. Operating profit margin, nearly double the industry. And net profit margin, nearly double the industry. Sweet deal, Devon Energy, huh? You want to shoot some holes in my investment theory here? I look forward to it. You can tell me in the comments what you think of Devon Energy. I like Devon at $50. Devon has a debt to capital ratio of 37, an interest coverage ratio of 20, and a quick ratio of 1.19. So the quick ratio is how much cash do you have compared to how much bills are due in the next 30 days or so. The current ratio is cash and cash equivalent. So then you can include that $3 billion facility in the current ratio. But in the quick ratio, we're looking at cash on hand versus current liabilities. It's more than one. Anytime it's greater than one, that's a good thing. It's all good. Interest coverage, 20 times. The industry is only at 12 times. And total debt to capital. So we talked about this a little bit. It's 37%, right? So don't give me the 0.6% EBITDAX number. Just tell me 37%. It's above the industry's average. Therefore, Devon still has a little bit of work to do in order to get the stock down to investment grade so they can pay less interest and be able to access the capital markets easier based on higher ratings. But this is pretty good in general. This debt, 37%, is not too bad. It's a pretty good picture. So, guys, that's a quick snapshot on Devon Energy. Sweet deal at $50. And for guys like me who are looking to potentially exit longs like I can, pickups would include Devon Energy with its 10% dividend yield, PE of around 5. There are a couple of others I like right now as well. I mentioned in the previous video as well. One of those Blackstone Minerals, that one pays a dividend of about 12%, but it's a master limited partnership. And Alliance Resource Limited Partnership, which is also a limited partnership, pays a dividend of about 14. Alliance is coal. So if you don't like filthy, dirty coal, because you're an ESG kind of guy, then you should probably stay away from that one. But if I had to move money out of ICANN Enterprise Partners, I would move it into stocks like Devon and Blackstone Minerals, BSM, and Alliance Resource Limited Partnership is ARLP. So those are kind of attractive to me for various reasons or different reasons, not necessarily the same. The other ones that you can easily move parking lot money into is XLE. You can always move some cash awaiting investment into XLE until you find something that is a really sweet deal, potentially like Devon, right? But anyway, let me know what you think in the comments. I like Devon. If you do, tell me why. If you don't, also tell me why. It'll be interesting. And we'll take it from there. I look forward to reading your comments and interacting with everybody. Thanks for watching. Take care. Bye-bye.